sort of based on the last question we had on Wednesday, which is a good question. So I want to pick up from where we left off. And our discussion was on the put-call parity concept that relates to how options prices are formed, and it all has to do with what I keep referring to as the Black-Scholes formula, and we actually haven't looked at that yet, but we will. In any case, I picked this example out of the Wall Street Journal to illustrate why the put-call parity relationship ought to hold approximately as we adjust for transactions costs, because if it doesn't, it's very easy to arbitrage an opportunity that presents zero risk. And the example I gave was, you're welcome, selling a call, buying a put, and we sort of ended with the discussion that, if you sort of look at these two payoff charts and add them together, it almost looks like it would be a short futures position. So it would make sense to combine those two with a long futures if, in fact, they're creating a short futures. If you combine them with a long futures, then you have a totally arbitraged position. So this is on your new slide that illustrates these possibilities. So over in the top left-hand corner, short call and long put, that was on the previous slide. That creates a synthetic short position, okay? And that's what this set of slides will demonstrate. So you have these two assets, and in effect, you've created a synthetic short. So to arbitrage the situation, then you need to go long futures, because if you've created a synthetic short futures, to arbitrage these two assets, then you buy a futures contract. Do you follow me? What you're trying to do here is take advantage of an anomaly in the market. It's just like when we talked about a carrying charge market that greatly exceeded storage costs. If storage costs were 25 cents and the price spread was 50, well, you'd buy the nearby, sell the distant, and then you'd earn a 25-cent return. Enough people do that, it drives it back down to the 25 cents. If there's an anomaly in the options market, that's easily arbitraged away. It's easily arbitraged away, and here are some examples of the way you can do that. So if you think there's an anomaly, you sell a call, you buy a put. The combination of those two, selling a call and buying a put, the combination of those two is exactly a short futures position. You've created a short futures position. So to arbitrage that short futures position, then so there's zero risk, then you buy a futures contract. So you've got a long futures, a short call, and a long put. That's what we saw in the previous slide. The other possibility, you have a long futures and a long put. You put those two together, and I'll show you a graph of that. You've created a synthetic long call. So you've got those two assets over here. You've created a synthetic long call. To arbitrage that, then you sell a call. You do the opposite, right? If you've created a long call, then to take out the risk, to be fully arbitraged, you would sell a call. If you have a short call and a long futures, then you've created a synthetic short put. In other words, you combine a short call and a long futures, and it looks just like a short put. So to arbitrage a short put, you buy a put, or you go long a put, okay? Oh, it's Montisha. She has permission to be late. So let's look at these three possibilities. So this is the one that we had examined on Wednesday, okay? So we've got a short call and a long put. So we've got the blue line, which is a long put. We've got a short call. And that creates the yellow line. That creates a synthetic short futures, this yellow line. I'm sorry I don't have a color printer for you. That creates a synthetic short futures, excuse me. So to arbitrage that, you buy a futures contract. And then you have those three assets that we looked at last time. So the yellow line is just a combination of this short call and the long put. And the easiest way to determine what the short call and the long put create is basically we want to add these two payoff lines together, right? So if we take point A down here, at point A, that looks like the futures price would be 16 or 616 and 3/4. This is the example that I started with on Wednesday. So the short call gives you a 0 return. That's why I picked it, because it's 0. So the combination of these two then must go through this point, because we're adding these two together vertically. And if this is 0, well, then it must go through this point. I do the same thing up here. Go find where the blue line crosses the 0 axis, and that's at point B, where the price is 557. So if the blue line is at 0, then the combination of the two must go through point B. So we can trace the sum of the two. We're summing the short call and the long put. That gives us the yellow line, which looks like a short futures position, right? It's identical to a short futures position. It doesn't cross the long futures position at the 0 intercept, because remember we said there was a 2-cent profit associated with this arbitrage. So it'll be 2 cents to the right of 571 and 3/4. And we can find where it crosses up top. I've written that down. Basically, we want to move down this yellow line so that we lose 16 and 3/4 cents, because if we're starting at this point, there's a profit on the short call of 16 and 3/4 cents because you've sold it. So if we move down this line until we've lost 16 and 3/4, then you add the two together and you're going to be at the 0 line, correct? You follow me? I'm just trying to find out where the yellow line crosses the 0 axis. And in order to do so, I'm adding this line, which is a short call, to the long put. In this range, the short call is worth 16 and 3/4 cents because you've sold it. So if I move down this direction, 16 and 3/4 cents, then I found the spot where it crosses, and it happens to be at 573 and 3/4. And that's our 2 cents that we talked about, on Wednesday. Let's do the same thing, but starting from a different position. This is the second example in your handout. Long futures and long put. Okay? Yes?
Would we have like a big paragraph, and this would be a huge problem kind of thing, and then we'd have to draw all this, or just kind of just helping us understand where?
This is helping you understand the Black-Scholes formula, and something this complicated won't show up until the final exam. Okay? But on the midterm, you can expect to see some payoff charts. But this is a little more complicated. Okay? And if I'm lucky, I'll get finished with Black-Scholes today, and I'll leave that for the final. Okay? So you can relax. But this is going to be very helpful when we get into Chapter 9, because once we get into Chapter 9, we see diagrams like this where we're adding cash positions, which will be 45-degree lines, with options, which will be kink lines. And we have to add those two together and determine what the hedged outcome is. So we're going to be doing some very similar analysis in Chapter 9. So it's helpful from that perspective. So here I'm starting with the second example, your long futures and long put. Okay, so think of the blue line and this 45-degree white line. Those are the two that we start with. You've got two assets, long futures and long put. What happens if we add these two together? What happens if we add the blue line to this 45-degree white line? Okay, this is the long futures. We're going to add that to the long put, and we see that it creates a synthetic long call, which is the yellow line. Okay, and again, we can determine what the sum of the futures and the long put is by basically Well, we'll start with point A, for example, okay? It's down here. This is point A, and that's the sum of this line, the blue line, and the 45-degree white line, the vertical sum. So at point A, that's our strike price. That's $6. If we go up the futures line from 571 3/4, we go all the way up to 6, then we're making a profit, aren't we? So up top in the box, I've got A. I've said $6 minus 571 3/4. So that tells me as we move from 571 3/4 up to 6, we've earned 28 cents on the futures. Okay? So if I take that 45-degree line up here, all the way up here to point A, which is going to be right about here, that would give me a profit if I measured it over on this axis of 28 1/4 cents. So that's half of my portfolio. The other half, of course, is the blue line, which is the long put, and we paid 43 cents for that. So we take our 28 1/4 that we made on the futures, we subtract 43, and we end up with minus 14 cents. So we add this point to the point way up top, and this is the sum, minus 14 cents. So you know that that's where the combination is kinked, because we're adding this kinked blue line to the 45-degree white line. So point A is one point on the combination, which is our synthetic call. We can take point B down here. The reason I chose B is that's where the blue line crosses 0. That always makes it easier when you're adding something to 0, right? And in this case, okay, so the question is, why did I choose the 43 cents? What we're trying to do is the following. We've got two assets. We've got a long futures that goes up and down this 45-degree line, right? And we've got this long put, right? So we're basically adding this payoff line to this payoff line. We're adding those two together, and we come up with the yellow line. So to find one point that's a combination of the two, I just picked the spot where it's kinked, because we know if we're adding a straight 45-degree line to a kink line, the sum is also going to be kinked, and it's going to be kinked at the same spot. So I want to find out where it's kinked at. So it's going to be kinked at the strike price at $6. Well, you know, at if the futures is 6, then you've made a profit on the futures of 28 1/4 cents. So that's one asset. You've got 28 1/4 cents. But in addition to that, you're holding this long put, okay, and it's just at the money. If it's $6, you haven't earned anything back from your premium that you paid, which is 43 cents. So you've shelled out 43 cents for the long put. The futures price has risen to $6. You've made some money in the futures. You've paid your 43 cents. We add the two together, and we get minus 14 cents. Does that answer your question? Well, what I'm trying to do here is to demonstrate that when you look at the options market, let's look at a put and a call. Is there a relationship between the price of a put and a call with the same strike and the same delivery month? And we said, yes, there is. It makes sense because there's so many underlying factors that are common to these two instruments, right? So there is a relationship that should hold at equilibrium. If it doesn't hold, then arbitrage will drive it back to its equilibrium. So we're just trying to understand how that works. And so what I'm doing is I'm taking two assets, a long put and a long futures, and I'm asking you, if you're holding a long put and a long futures, what's the combination of those two? You combine those two, and essentially you've got a long call. You've created a long call. So if we take the blue line and the 45-degree white line, we have created the yellow line. That's the whole point here. We've created the yellow line synthetically. So to arbitrage the creation of the yellow line, what you have to do then is sell a call. Because if you created a long call, then you sell a call, you've taken out the risk. Okay? And so what I'm trying to do is show you what the yellow line looks like. And to determine that, we have to add the blue, the long put, to the long futures. It's going to be kinked where this line is kinked, and we find the spot is right here at A. I then go over here to B. I chose B because that's where the long put is equal to 0. You just get your premium back. And that happens to be at a price of $5.57. And then you've got this futures position. Well, if the price has fallen from $5.71 down to $5.57 down to B, then you've lost on your futures position 14 cents. Okay? The price has gone down to B. You've lost 14 cents. So that gives us another spot on that line. So we know that it's here, it's kinked here, and voila, we have our synthetic long position. So you sell a call, then you go and look in the market, and you can see that you can sell a call for 16 cents. So there's your 2-cent profit, right? And if you went to the market and you saw that the call was trading for 24 cents, well then you'd sell one and you go back in a second, you sell another one, right? Because then that arbitrage is going to pull these two together, so the spread is the same, right? It's almost the same because there are some transactions costs. But if you've got this blue line and the futures creates the yellow line, right? Then you check the market. You say, okay, what price is this at? And you compare it to what you've created. You've created a long call with a premium of 14 3/4 cents. If you can sell a call for something higher than that, then do it, because it's a riskless position. And if the market was out of whack where that call was trading at some price much higher than 16, then there would be a risk-free return. And that's what traders do on a daily basis. And that's why these prices are kept in line. Getting a lot of blank stares here. Have you read Chapter 8, where we describe these payoff charts and I talk about put-call parity? You can leave it till Sunday night, right? Yes?
How quick are the anomalies corrected? Is it like really quick?
The younger traders can correct them more quickly than the older traders. That's why you guys have an advantage over me when it comes to this stuff, right? It's like in the futures market. I mean, there's a lot going on in the pits, as you've seen in the videos, and there are people who make a living doing this, basically. And if there's 5-cent profit there, that's a lot of money to a trader who's trading thousands of contracts at a time. And that's why when you look at those premiums, they will mostly adhere to the put-call parity relationship. Okay? Okay, let's do the third one. And this is where we have a short call and a long futures. That creates a synthetic short put. Okay? So we have a short call. This should be pulled over here to this line. That's our short call. We've got a long futures. Okay? And that creates a synthetic short put, which is the yellow line starting from the top. Okay? And then you'd arbitrage that with the purchase of a long put. So go back to the first slide. Short call, long futures creates a synthetic short put. We arbitrage it with a long put, which is the line on the bottom, the blue line. So we've got a long futures. So this is the line here, this 45-degree line. Okay. We've got a short call, which is this one here. We want to add these two together to determine what we have created. And so again, I will start about here at the $6. Okay. So if we take $6, and the reason I chose that is that's where the short call is kinked again. So if we add the two together, it's going to be kinked at that spot. So up in box A, we know that, as we saw before, if the price is $6 and we bought the futures at 5.71 3/4, then we've made 28 cents on the futures. So that's 28 cents on the futures. We've sold the call for 16. Okay, so we add that to the 28, which gives us 45 cents. So the short put will have a flat spot at 45 cents. And that's what you've created, essentially, by owning a long futures and a short call. Essentially, you have sold a put option for a premium of 45 cents. That's basically what you've done. And you want to arbitrage that by buying a put. Because essentially, with your long futures and your short call, you're holding a short put. You don't want to take the risk of holding this option. So what do? You buy a put, the risk is gone, and you look at the market, and you can buy a put for 43 cents. You've sold essentially a short put for 45, so again, you've got your 2-cent profit. Right? This blue line, that's where the market is trading. That's the long put with a $6 strike. It's at 43 cents. You've created a short put with a 45-cent premium. So you buy this one and you make 2 cents. So again, that's where the 2 cents comes in. Okay, so clearly you'll have to practice these, and as I say, once you get into chapter 9, I think you'll find this very helpful, because by the time we meet on the final exam, I'll be expecting you to work with diagrams like this, where I give you some information on, let's say, 2 assets, and the asset might be a cash position and a futures position. It's really no different than holding a futures position and an option. So it might be a cash position and an option. So you might be long cash and long put. I'll ask you to combine the two and draw a payoff chart. So it'll be doing something very similar to what I've just done this morning. Yes? Yes. The question is, where does the 2-cent profit come from? So you're looking at the market. You buy a futures contract and you sell a call at the same time. So you're holding these 2 instruments. In essence, what that gives you is a synthetic short put. It's identical to having sold a put option for 45 cents. Okay? So it's created that yellow line. Then you look at the market, you walk over to the trading pit, and you see that you can buy a put with that $6 strike for 43 cents. So if you could sell one for 45 and buy it for 43, then that's a riskless return of 2 cents. Okay? So you've created the short position, then you just go in and buy the long position. Does that answer your question? Yes. Okay. Okay. Let's carry on. So we'll come back to these type of diagrams, as I say, on chapter 9. So now this looks easy, right? Let's just review these payoff charts, because this is what you'll need for Monday. So we've spent time on the difference between puts and calls, and you know that you can either go long or short. And so you should become familiar with the shape of these diagrams. And the best way I can think of practicing for the exam is to simply take the Wall Street Journal and randomly pick some options, pick some calls, some puts, different strike prices, and draw the payoff chart, assuming you've either sold it or bought it. Okay? Do 6 or 8 of these examples, and I think it will come to you very quickly. So generically, this is what they look like. If you have a long call, well, it's going to start below the 0 because you have to pay the premium, right? When it hits the strike price, then it's going to be kinked. And then you will start to get your premium back as the futures price continues to rise, because this is the underlying futures price. Eventually you hit a break-even price where it crosses the 0 line. This is the break-even here. And then you move into the positive territory. If we look at the expected profit for the long call, which is that equation up on top, well, it's the maximum of either the premium. Of course, that's the most you can lose. So it's the maximum of either the premium or the futures price minus the strike price minus the premium. So the most you can lose is the premium, and the most you can make is the futures minus the strike minus the premium. So obviously, the higher the future goes up, the more profit you will make. If we look at a long put, just the mirror image of this, it has a flat spot below the 0 line because you're paying for it, right? You're paying the premium. So this amount here is equal to the premium. It will be kinked at the strike price. If the futures price stays high, stays over here, then this option stays out of the money. When it hits the kink, then it's at the money. And as the futures price falls, then it moves into the money. If you buy a put, you think the prices are going to fall. And so if it hits the strike, then it's at the money, then it moves into the money, and eventually you get the positive territory if it falls far enough. The expected profit on a long put is either the premium, which would be a loss, it's minus the premium, so that's the most you can lose. This is the most you can lose. The most you can make is the strike minus the futures minus the premium. So the most you can make is a strike minus the futures minus the premium if the price falls. And so basically, you want the futures price to fall because the strike price is constant, right? The premium is constant. As over here, the strike price is constant, the premium is constant. To get a maximum here, you need the futures price to rise. To get a maximum here, you need the futures price to fall because you're subtracting it from the strike. Any questions on these two simple payoff charts? Yeah.
Theoretically, there is a limit to profit, right? And that's on the long call there isn't, is that right?
Right. Yes, because with the long put, if the price falls to 0, okay, then the most you can make is a strike minus a 0. That's right. And with futures, well, it could go to the moon, right? Okay, what do the short positions look like? We have a short call or short put. A short call has a flat spot as well, but it's in the positive territory instead of the negative territory, and that's above the 0 line by the size of the premium. It's also kinked at the strike price. It's kinked at the strike price. Over here, it's in the money, right, to the right of the strike. Over here, it's out of the money. You're selling a call, so you hope the prices don't rise, right? Because the buyers of the call, they want the price to go up. You don't want it to go up. When you sell a call, the expected profit is the maximum of either the premium plus the strike minus the futures. And you can see that that can become negative if the futures rises high because the premium is constant, the strike is constant. So you don't want this number to get too large. If it does, then it will swamp these two, and you'll have a loss. As Mary said, the potential loss is very huge for the seller of a call. The maximum profit's a premium. The most you can make selling the call is a premium. If you sell a put, well, again, we're mirror image here. To the right of the strike, the put's out of the money. To the left of the strike, it's in the money. Strike price is right here where it's kinked. The most you can make is the premium, which is this amount. And your loss will equal the premium, which is constant, plus the futures price minus the strike, which is constant. So if the futures price falls, then it moves into the money, which is not good for someone who sold the put, because then you move into negative territory, and that's where you have a loss. Okay? So these four types of charts are the thing that's going to show up on Monday. You should practice these payoff charts, and what we'll do is we'll put some numbers on them. We'll pick the Japanese yen or the treasury bond, and we'll pick a call or a put, and we'll say, suppose you sold this or you bought that, draw the chart, and label it. I want to see where it's in the money, out of the money, where's the strike price, where's the break-even price. What are the axes? Okay, the expected payoff is a vertical axis. The horizontal axis is the futures price at expiry. Label it carefully. Yes?
Labeling, if the buyer of the option is out or in the money, right?
I'm sorry, can you start over?
No, because I know.
Which one are you pointing at, first of all?
Well, either one.
Okay.
Supposedly for the short call.
Okay, so we're selling, if you're short, you're selling here. I thought you said buyer, okay.
So for the short call, when it's out of the money for the person who's buying the option, it's in the money for the seller option because they're just getting the premium, right? So.
No, if it's out of the money, it's out for both. Right. And when you sell it, when you sell an option, you want it to stay out of the money, right? You don't want it to be exercised. Well, technically, it's out of the money. Okay. Well, that's the way it's defined. Okay. That's the way it's defined. Yeah. But I understand what you're saying. For the writer, I mean, if it's out of the money, that sounds negative, doesn't it? You know, it sounds bad. But actually, for the writer, that's good. Yeah. Okay. And out of the money, again, just means that it has no intrinsic value. Okay. So that's where that term comes from. But I understand what you're saying, because for the writer, you'd think that, well, I want it to be in the money, but actually, no. Yes, Mary?
Since there's just like that limited profit, there's that limited maximum profit with the premium.
Yeah.
Use like what we were talking about before in combination of other things to create such and such.
Okay.
They're not really, because it doesn't seem like speculating would be okay.
Okay. So the question is, given that there's a maximum profit, right? And so far in this class, you know, we've heard our friends on the videos talk about unlimited profits. It's the first time we started talking about limited profit. Why is there incentive to write options? And so Mary's question is, are most of these options written by traders who hold other positions? That's essentially what you're saying, where some of the examples we looked at earlier this morning. Yes and no. Clearly, a lot of the options that are written by traders who have underlying assets that might offset the risk of writing it, as we saw a few minutes ago. But there are also a lot of traders that are willing to write options based on their price expectations. And again, it's all a question of probabilities, right? And if you think that there's a high chance that this thing's going to move in the money, and it's out now, if it's out, but you think there's a high chance it's going to move in, well, you just ask for a larger premium. So that would just shift that up. So there's a lot of money to be made writing options, because a lot of options end up expiring worthless, out of the money. You just look at the Wall Street Journal, and when we were circling the ones that were in and out, there's a lot that are out, and they'll stay there. Yeah, there's no option traded unless you have a buyer and a seller. So if I'm a writer and I go in the pit and I want to sell an option on crude oil, you know, I'm going to go home empty-handed unless somebody's willing to buy it from me, and we agree on a premium. Yeah, it's just like with a futures contract. Okay, we're brightening things up here a little bit. So the call option, the maximum price is the futures price, and this is something that Mary was alluding to earlier. So the call option, as you know, the futures price can continue to rise, so it's almost unlimited. With a put option, the maximum price is the strike price, because we're going south with puts. The minimum price with a call is either 0 or futures minus the strike, and with a put option, it's either 0 or the strike minus the futures. This is now leading directly into Black-Scholes because it gives us an idea of where these premiums are trading, right? We've talked about the premium. We know what the components are. It's the intrinsic value and the time value. We know how to do all that. We know that premiums for the same strike, but a put and call are related. Okay, so there's lots of information here. But what is it that determines the size of the premium? Well, we talked about supply and demand. We've talked about the difference between the strike price and the futures price, and we've talked about volatility. Now this all comes together. We need to put some parameters on these premiums, and that's what Black-Scholes does. In the book, there's a reference to a website, and I'll actually go there next Wednesday. It's called www.freeoptionpricing.com, and you ought to check it out. You can go to that website and input numbers. Take the Wall Street Journal and input the strike price, the futures price, the days to maturity, and then I'll ask you for a volatility estimate, and you can give that, and then it'll tell you what the premium ought to be and compare it to what's in the Wall Street Journal. And it's amazingly accurate. And this is what it's all about. So here's a call option, and we have the minimum and the maximum value. So we said that the maximum value was the futures price, okay, because even if the strike was 0, nobody would pay more than the futures price for an option, right? No rational person would pay more than the futures price. So if the futures price goes this direction on the horizontal axis, this is the futures price, and the premium goes this way, then the maximum will be along that 45-degree line. That's the most anybody would pay for a call option. If the futures price is $2, the most you'd pay for the premium is $2. So that borders one side of where the premium might lie. The premium can lie anywhere in this gold area. It will also have a minimum value, and the minimum value is going to be the intrinsic value. Okay? So the minimum, as we said in the earlier slide, is either 0 or futures minus the strike, which is, we know, as the intrinsic value. So let's say the strike is $5.10 in this case. So the minimum will be 0, 0, 0 until we hit the strike. And then as the futures rises above the strike, then it takes on intrinsic value. So we have our minimum traced out by this 45-degree line that hits the horizontal axis at the strike price. So that gold area gives us the theoretical range for a call premium. The most the call premium would ever be is the futures price. The minimum is either 0 or the intrinsic value, so it can range anywhere in that gold area. Where does it lie in the gold area? Well, you certainly don't see the premiums up against the futures price. They tend to be down in this direction. As the futures price changes, the premium will change along one of these lines, A or B. It might lie on B if the volatility is a bit low in the market. It might lie on A if the volatility is a bit high. But as the futures price rises, there'll be a tendency for the premium to rise because it's a call option, right? And so that premium will rise with the futures price. So generally we move along a path like A or B when we're looking at what happens to the premium. This is the same story for a put option. We said that the maximum value for a put option is the strike price because you're buying the right to sell at the strike, and even if the futures price goes to 0, that's the most you would ever make, so you would never pay more than the strike price. So we set the maximum at 510, which is the strike, which gives us this horizontal line. The minimum will equal the intrinsic value for the same reason that it does in the case of a call option. I mean, a rational trader would pay at least the intrinsic value because you can turn around and reverse your position and get that much back. So if the strike is 510, well, the intrinsic value is going to be 0 if the futures price is above 510. But you know once it hits 510 for a put, then it moves in the money, and then we move up. That should be a straight line. We move up that minimum path, which traces out the intrinsic value as the futures price falls, right? If the futures price ends up at 0, well, the intrinsic value is 510, which is strike minus the futures. So now we have this white area that traces out the potential premium for a put option. The put option premium could be anywhere in this area, but at least we know where it's bounded. We know the maximum and the minimum. And again, it will be on one of these lines. You can't see the letters here, but I've got B and A on the line. And so with a put option, okay, as the price falls, the premium will rise. And remember, with a call option, we saw the premium rising when the futures price rose. With a call, when the futures price rose, the premium rose. With a put, when the futures price falls, the premium rises. So you've got the opposite sign. And it will rise along one of these paths, either the lower or upper, depending on volatility in the marketplace. So what the Black-Scholes formula does is it takes all this information and it basically estimates where we are in this white area. It'll give us a point estimate of what that premium ought to trade for. Yes. It should be 510. I've just got carried away with my pen here. There's a little line here. Okay. It's 510. I need to redraw that. Okay. Excuse me. That's all I'm going to do. I'll see you Monday. Montisha's going to take over. Good luck.